We'll be putting a tariff on of approximately 100% on chips and semiconductors. But if you're building in the United States of America, there's no charge.
Hello, everyone, and welcome to the Week Ahead on Nomura Podcasts. I'm Eugen Paracuelas, Chief Southeast Asia Economist at Nomura, and today is Friday, the 8th of August. The barrage of tariff headlines continues, including the tariffs on semiconductors, as you heard there from President Trump, and the escalating tensions with India. Global financial markets seem to have taken these fresh headlines in their stride so far, but in the week ahead, all eyes will be in the US CPI data once again, which, as our US economist Jeremy Schwartz explains, is likely to tick up, potentially complicating the Fed's thinking after the weak jobs report. Elsewhere, Josie Anderson from our economics team in London gives us a preview of the key data releases from the UK and Europe, as well as the Nordea Bank decision coming up. My co-host Andrew Ticehurst and I also compare notes and discuss the contrasting outcomes we expect from the Reserve Bank of Australia and the Bank of Thailand. And finally, in a special segment in this episode, we zoom in on the US dollar, and Craig Chan, our global head of FX strategy, expounds on why keeping a soft medium-term dollar view makes sense. So let's dive in.
But sitting here today, I could see 2 rate cuts this year. But if it turns out that tariffs are having a bigger effect on inflation and it's more persistent, we could do 1 or more rate cuts and then we could pause.
All right, let's kick off with the U.S. and joined by Jeremy today. Thanks for joining, Jeremy.
Thanks, Eugen. Great to be back.
Yeah, of course. First question for you is the all-important U.S. CPI data for July, which is out on Wednesday. Saw your preview report. So just walk us through in terms of your expectations there. And in particular, I'm interested if you see more inflationary impact from the tariffs showing up.
Yeah, so we're forecasting an acceleration in core CPI up to 0.34% month on month, up from just around 23 basis points in June. And we think that's driven both by tariff-induced price pressure for goods as well as some stabilization in volatile service components, which had been keeping supercore inflation down the past couple of months. So we think core goods prices likely rose 0.44% month on month. That would be the highest since May of 2023. We see tariffs continuing to push up non-auto core goods prices, and auto prices, which had been soft the past couple of months, appear to have stabilized. At the same time, a couple of supercore components, things like travel-related services, lodging away from home, and airline fares, have been very weak, contracting the past couple of months. We think that those stabilize. So, if our forecast materializes, that would roughly pass through into a core PCE reading of 0.325. That would be another month of acceleration, and it would take the year-on-year reading for core PCE just below 3%, and the 3-month annualized pace to around 3.25%. So we think that you really are starting to see not just tariff-related price pressure is really starting to materialize and push the headline numbers higher. But I think also some of those lingering last-mile issues in supercore services inflation, which have been on the radar since the start of the year.
Okay, wow, that's important. Now, if you take that in combination with the NFP data that we got last week, do you think that complicates a little bit the Fed's thinking in the sense that first of all, what do you think of that NFP print and the revisions, and whether labor market weakness could start to take on a larger weighting in the Fed's reaction function as a result?
Yeah, so we do think that after the NFP report, the Fed is going to feel very cross-pressured with the dual mandates. So what you saw was a pretty significant momentum slowdown in employment growth, with not just a disappointing July reading, but also substantial downward revisions to prior months, taking the 3-month average pace of NFP down to just 35K. I think the important distinction in our view, though, is the difference between a slowdown in the labor market and stress in the labor market. So despite a lot of the momentum weakness we've seen, the missing piece has still been, there are no widespread layoffs yet. So initial jobless claims remain low. Signs of job losses in the household survey are towards the low end of their range. And even the JOLTS survey showed layoffs and discharges towards the low end of their range. So we do think that the Fed will be increasingly concerned about the labor markets. They're not going to be able to point to a strong labor market as a reason to remain patient. But we don't think that they have to be totally reactive and panicked yet and begin easing as if they're behind the curve. Because the labor market, despite this course correction in the July print, still does seem to be on a gradual slowing path rather than sharply deteriorating.
Okay, got it. And lastly, staying on the Fed, so we've had some Fed speak this week, which seems to be a little bit dovish, as you've heard there in the earlier clip from Kashkari in his CNBC interview. What do you make of these signals, and do you think this imply that we have a rising probability of a September cut in line with what seems to be priced by markets?
Yeah, so we do think a September cut is a close call, but we continue to think that the Fed will remain on hold. So the Fed speak we've heard since the NFP has largely been concentrated in some of the less influential regional Fed presidents who aren't voters on the committee this year. And what we're hearing from them is a little bit of impatience with this wait and see approach. Kashkari in particular was interesting because he really pushed back against the entire risk management framework, simply saying, the labor market has weakened, so we should ease a little bit in response to that. Which is in contrast to folks like Powell and Williams, who have really emphasized wanting to wait and see and gain confidence that inflation isn't going to pick up. That said, we do think that if you get a CPI report like what we're expecting, and you don't get too much follow through or signs of stress from the labor market weakness that we have seen, then the priority still has to be inflation. It's very difficult to ease with inflation above 3% or kind of in the 3% area for core PCE. And we think that you really have to see some amount of stress for them to go ahead and cut in September. We don't think that that's going to materialize in the labor market data. And in particular, we think you're probably going to get some decent prints for things like retail sales next week as well. We saw Q2 consumer credit data showing that household balance sheets remain healthy. Despite the labor market weakness, wage growth is still on the higher side. So we don't think that this is the kind of shock that is going to force the Fed to kind of be very aggressive, feel like they're behind the curve, and have to cut quickly to stabilize the labor market or financial conditions. We do think that patience will ultimately win out and that they will remain more focused on inflation, which is above target and has been above target for over 4 years now.
Okay, great. And that means our baseline remains for the cut to resume in December, right?
That's correct.
Okay, brilliant. Thanks, Jeremy.
Yeah, thank you.
Okay, now let's swing over to London. Hey, Josie, thanks for coming back to the podcast.
Hey, Ewan, thanks for having me.
Okay, let's start with the data. What are your expectations of some of the key releases like UK labour market data and GDP, as well as the ZEW survey?
Yeah, thanks. So to start with that UK data, we get lots of labour market data here in the report to watch, but overall we expect continued softness. So we'll get payrolls data that people have been watching a lot more lately. We expect a 30k month-on-month fall, and that will continue the trend of declining employment that we've seen recently and follow a 41k fall in June. There was a large fall in May that was revised away last month, so this series is quite volatile and does see large revisions, so that's something to note. We expect the unemployment rate to remain unchanged in Q2 at 4.7%, but that itself is 0.6 percentage points above its low point last year. And another point to note is private sector regular pay growth. We expect a 0.3% month-on-month rise. That's broadly similar to the rate seen over the past 6 months, but is slightly above the pre-pandemic average of around 0.2% month-on-month. Turning to UK GDP, we've seen weak UK GDP growth over the last few months, it fell by 0.1% month on month in May after a 0.3% month on month fall in April, and industrial production has been a large source of weakness. We forecast a slight rebound with a 0.1% month on month rise in June, and so that would suggest a 0.1% quarter on quarter growth in Q2 as a whole, though of course revisions to the back data could change that. Finally, on ZEW in the euro area, it has a good relationships with the Centix survey, where investor sentiment dropped sharply in August. In our view, this was likely in response to the weaker US non-farm payrolls data that we had recently. We like to focus on the German ZEW, and we think this likely deteriorated in August in line with that Centix survey.
Okay, wow, lots of data coming up, both in the UK and also in Europe. What about central banks? We've got Norges Bank next week. And if you have any quick takeaways from the Bank of England, which has cut rate a few minutes back, that would be good as well.
Yeah, thanks. So the Bank of England, of course, cut its policy rate by 25 basis points. That was as expected. Markets priced that in almost fully, and economists also expected that cut. But what was interesting, actually, was the vote split. So there are 9 members of the Monetary Policy Committee, and actually a second vote was required because the first vote saw 4 voting for a 25 basis point cut, 4 voting for no change, and 1 voting for a larger 50 basis point cut. So then there was a second vote in which that Taylor, who voted for that 50 basis point cut, switched to a 25 basis point cut, so that in the end we saw a 5-4 split with the majority voting for a cut. So obviously this was quite a hawkish cut, with those 4 members voting for no change, and to them it's very important to see the disinflationary, more evidence of disinflationary pressures. Indeed, the main guidance of a gradual and careful approach to the withdrawal of restriction did remain. So they still admit that rates are restrictive and that more cuts are needed, but we're getting closer to the point where that isn't the case. And there was more wording in this report that changed to say that the restrictiveness of monetary policy has fallen as bank rate has been reduced, and the timing and pace of future reductions in restrictiveness of policy will depend on the extent to which the underlying disinflationary pressures continue to ease. So lots of members do want more evidence there, because inflation remains quite high in the UK. Turning to the Norges Bank, this is in Norway, inflation also remains fairly sticky. We expect no change in rates in August. The policy rate should stay at 4.25%, but this follows a large surprise at the last meeting when policymakers cut, and no economist was expecting a cut because inflation is so high, but they want to start the normalization process and bring gradually rates down towards a more normal level. We also get Norway inflation data actually next week, and we're expecting 2.9% CPI inflation, so it remains fairly sticky.
Yeah, cool. And yeah, finally, we don't often talk about Switzerland, but I guess it's been on the spotlight recently because of the 39% tariff that it got from the US. Any update on the trade negotiations and whether there's any prospect that they could reduce that 39%?
Yeah, that 39% came as a big surprise because it sounded like negotiations were going quite well ahead of that announcement. And actually, as we're recording this today on the 7th of August, that higher tariff rate has now come into effect. And the Swiss president has actually returned from an emergency trip to the US and has not yet managed to negotiate a lower rate. And so Swiss officials are meeting to decide on probably what they can offer the US as a more attractive bargain. We think actually even more important than trying to get a deal on this 39% for the US is actually pharmaceutical tariffs, because pharmaceutical exports from the Switzerland to the US in 2024 made up around 60% of goods exports from Swiss to the US. And so if there is a higher pharmaceutical tariff, that could have an even bigger impact on exports for Switzerland than the tariff rate on other goods. So that's something key to watch out for as well.
Yeah, absolutely. We're watching that here very closely in Asia with the pharmaceuticals sector and the negotiations there as a sort of potential template for us to expect what might come. Great. Thanks, Josie.
Thanks a lot.
All right, let's go to Sydney. And I've got my co-host, Andrew, to talk about the upcoming RBA decision on Tuesday. We have the Bank of Thailand as well on Wednesday. So, yeah, Andrew, let's just compare notes.
Yep, sure. You've been great to be with you. Thanks.
So, I guess the question for you is you are expecting the RBA to cut, which follows the shock pause that they had last time. What is the rationale for them to go ahead now? And what's your conviction level in that forecast?
Right. Yeah, look, they did stun us in July by not cutting when 24 basis points of easing was priced. The ABA expressed a preference to wait for a little more information at that time. We've had labour market and CPI data since then, and pretty much the data have spoken. So Q2 CPI was fairly benign. The core rate rose 0.6. The RBA had been a bit nervous about that one, but that looks okay. And the unemployment rate has risen from 4.1 to 4.3. So together, I think that's more than enough to get your 25 basis point rate cut. I'd put our conviction at that, around that at a pretty high level, maybe 70, 75%. I would note the market is about 100% priced for a 25 basis point easing as well.
Okay, that's interesting. For the Bank of Thailand, in contrast, we have them keeping the policy rate unchanged again. But I'd say this one's a little bit more of a close call. We have a 60% probability to that outcome versus a 40% that they deliver a 25 basis points cut. And I guess the thinking is, again, like you say, it's all about the data. And it seems like they might prefer to preserve policy space, as they mentioned last time. And they said that second quarter GDP growth is tracking almost the same as the first quarter, as opposed to falling sharply already. So perhaps they could afford to stay patient at this time. The MPC vote would be likely 5-1, the same as before, with one dissenter for a cut. Now, on the RBA, how do you see the tone or any forward guidance, and how does that fit with your own forecast in terms of how much more they can cut in this cycle versus what's priced in?
Yeah, right. This is an interesting one. While we're really quite confident we will get a cut, we wouldn't describe the communication as likely, particularly dovish. I think it'll be fairly balanced communication. The RBA have been flagging a cautious and gradual approach to easing. I think there's a couple of reasons for that. One is that the economy is not especially weak. It's more a case that we have lower inflation allowing a little bit of easing rather than a weak economy crying out for multiple rate cuts. The other thing that's going on here is the RBA is really pretty uncertain about NAIRU and the neutral cash rate, so U star and the R star for us economists. In that sort of environment, I think they'd rather creep slowly and let future data on unemployment and inflation dictate what they do. That data is only going to come out slowly. They rely mostly on quarterly CPI. And yeah, for that reason, we've got them cutting twice more, but slowly. We've got another 25 bips in November and another 25 in February. That would take their cash rate down to 3.1.
Yeah, okay. So data dependent and gradual approach. I guess for the Bank of Thailand, the tone that we expect from the statement should still be dovish because we think they will acknowledge that the uncertainty is still quite high on the external front, which I think is fair. And obviously, there are some downside risks. And that should suggest that they're still keeping the door open for further cuts later on. And our growth forecast for the year is definitely a little bit lower than the BOTs because of our view that Thailand is not just vulnerable to the tariffs, but also the starting point is already quite weak. Domestic demand has been under pressure for some time. And headline inflation, I think it's probably one of the few countries in Asia that's already running negative, and we expect deflation readings for the next several months. So I think that should still mean that there's scope for them to ease when they find the timing warranted. So on the back of that, we have them cutting by another 75. That would take the policy rate to 1% starting in October. And I might add, that's also when the new governor takes the helm. And our view is he's relatively more dovish than his predecessor based on his comments. So that should support further our forecast. Any other things to flag for the RBA, Andrew, that you're watching? Maybe any risks or potential surprises again?
Yeah, look, it was interesting to hear you talk about the vote count for the Bank of Thailand, 5-1. Down here, we'll be watching the vote count too. This is a new development for us. The RBA has only started publishing a vote count last month. They've told us they'll continue with that sort of process. There's 9 people on the board for the RBA. Last month, the decision was 6-3, so 6 voting for no cut, 3 voting to cut. This time around, look, it could be a unanimous decision, 9-0 in favour of a cut. But look, despite that, I think that guidance will still remain cautious. I guess the other thing, we're all watching the Fed, and Fed officials talk about potential for multiple rate cuts. RBA governor could be asked about that, whether that has implications for Australian policy. I suspect the answer would be no. I think the RBA is mostly focused on the local labour market and inflation data here.
Okay, let's see you next week, and good luck to both of us. Thanks, Andrew.
Excellent. Thanks, Ewan.
Finally, let's zoom in on FX, and I'm thrilled that no less than our Global Head of FX Strategy, Craig Chan, could join me today. Craig, thanks very much for coming back to the podcast.
Yeah, thanks, Ewan. It's a pleasure.
So, it's great that you're here because obviously the US dollar has been in focus all year long, and you've been consistent with your view of bearish US dollar path over the medium term. Obviously, we've had some recovery in the month of July, but then we had weaker than expected labor market US data. And all the headlines about tariffs recently. So are you still sticking to that weak dollar view?
Yes, totally. Look, I'm still very much on the view that the dollar will weaken. That move in, last month was from a few things. And I think some of them are kind of temporary. The short positions being squeezed. We had Japan political uncertainty still there, but I think far less so. And then some fears around, U.S. goods prices, and of course, Trump's approach to kind of escalate on tariffs. But I think we're broadly in de-escalation phase, and globally on Trump tariffs, but not everywhere. Obviously, there's some places that are seeing still some intensification. But I think the other factors, they've largely played out. I think there's still some uncertainty around U.S. goods inflation, of course, still there. But yes, still very much on a softer dollar view. If I can, just highlight, very quickly the reasons I mentioned briefly on the softer dollar. And look, I want to say, the first one is around our house view around U.S. growth slowing, and there's going to be a clear narrowing of the gap with Europe. The second one is on flows and stock of foreign investments into the U.S. The bottom line is that it's still extremely elevated, and I do see a risk that if the U.S. macro weakens, then certainly there's that potential for actual capital outflow. At this juncture, I would say there has been a little bit of improvement of inflows into US, but still very weak compared with the kind of US exceptionalism periods through, I guess, most of 2024 and part of 2023 as well, which is a problem, right? Because then, you've got these large twin deficits that you basically have to finance, and that's a problem. And then I would just say just two last things, which are very important. One is around FX dollar selling hedging activity, which I think can proceed again. If you see the dollar starting to soften, then the momentum certainly builds in that way. And then the second one is around the Fed chair, all the concerns about credibility.
Yeah, absolutely. And I guess the U.S. exceptionalism in question because of that, not just the weakness in the labor market data, but also the downward revisions in the previous month, which seems to be a little bit more aligned to that, softening in U.S. growth outlook. And in terms of your sense of markets, Craig, in terms of the thinking about this dollar, you just came back from London. What would be your sense where they are in terms of that and your top takeaway from that trip?
Yeah, look, so I was in London last week, so not too long ago. And we were marketing our kind of multi-month softer dollar view. It was a tough time to market because obviously the dollar was bid through at that period. But to be honest, I'd say most of the clients, maybe up to 80%, were in line with our view that there was a kind of softer dollar that was likely to emerge over the multi-month period. But I think most clients had little positions because obviously, we had this consistent grind up in the dollar for several weeks. So convictions were low, but the rationale wasn't too different from ours. But I would say it was interesting to note that as we move through, the final part of the week, just before the non-farm payrolls report, there was definitely this kind of minority group which grew in numbers, and their view was that the dollar could actually turn and start continue to trade on a stronger bias. They were saying, trade deals are benefiting the U.S. They were talking about U.S. exceptionalism. Maybe back. They were even stating to me that there was evidence of, capital inflows into the US returning. But I think after payrolls, probably that conviction has dropped off quite a bit.
Yep. Interesting. And yeah, finally, in this environment, Craig, which currencies could you see outperforming the most?
Sure. So I think we're of the view that Euro has still quite a bit of upside. We do think that, for example, Euro can outperform the India rupee. This is actually quite a high conviction of ours. I don't think it's so much just around the view of a softer dollar, but I think, it's quite a bit to do with the kind of political risks that have been emerging with US obviously imposing some policies against India to strike a deal. And I think the combination of, the downside macro risks that were there before these, if you want to say, U.S. actions were taken on India, along with, already kind of a weakness around the balance of payments, particularly portfolio outflows, these things are going to intensify even more now. And so I think there's quite a strong divergence that could emerge. Europe outperforming that of, India rupee. I think this is something I think will work quite well over a multi-month period. I'd probably also state one more. I think there is also the scope for yen to outperform the dollar as well. So dollar yen effectively moving lower. And I think this would actually, as in yen outperformance, would be, expressed. It would express the slowdown in the U.S. Macro environment for sure. I think it also, if we do see, let's say, U.S. equities begin to sell off, then we could see yen outperform the dollar in that backdrop as well. And of course, as I mentioned earlier, there's the risks around Fed. The Fed chair and the Fed independence, and clearly, I think yen strength would capture this risk for the market as well. So yeah, two potential outperformers here: yen against the dollar, and euro against INR.
Yep, that's very clear. Fantastic. Thanks very much, Craig.
Thank you very much, Ewan.
That's it for now, and thank you again for listening to our podcast, edited and produced by John Dalton. Please like and subscribe to Nomura's podcast on Apple, Spotify, and SoundCloud, or your usual podcast provider. We'd love to hear your feedback, so please feel free to write a review and share this podcast so anyone you think might be interested. You can check out NomuraConnects.com for more of our research and updates. Have a great week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting, or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.